Good morning, everybody, and welcome back to the channel. Today I have with me Nigel Standish, and he's the founder of StandishCo, a premier business advisory. And I'm going to let Nigel introduce himself and give you a fair bit of background. So, Nigel, take it away, please.
Great. Thanks, Martin. Love to be here. Yeah, I am a chartered accountant by trade. So started off like many accountants do in the Big Four in an auditing role, which gave me a unique window on lots of businesses, large and small, and understanding how they operate, which was great. But, rather than, continue up the greasy pole of chartered accounting, moved over to become a CFO in some large media businesses, both in Australia and overseas. And I think that gave me a unique perspective on actually paying the bills and being responsible for your own general ledger, which was great. And then I think now I've combined all of those skills into my own small advisory firm, which is StandishCo. I've got a team that supports me working with a small range of clients in a sort of external CFO and business coaching role, blending both numbers and operations and strategy to deliver for my clients, which, is a really enjoyable and rewarding place to be.
Yeah, no, I think with that introduction, what I can say is that because we've both worked together on a couple of clients and we've had positive outcomes, it shows about having the right set of advisors and the right background in your advisors in order to help you grow your business and move forward. Yeah, so look, I know because of the sort of work I do, quite a few business coaches, and I've found the best of them obviously have an accounting background, because one of the things that small businesses often have issues with is understanding their real financial position. Look, I keep talking on about the difference between profit and cash flow, which is something people are often having trouble getting their head around. They're saying, hey, look, I made $200,000 this year, but I've got $2 in the bank. Why is this so? And so it's explaining those, and having a business coach is not really about what I call sales manager style talk. It's about, I suppose, being at the top of a business is a lonely spot, and having a confidant and someone who understands your numbers and you can have a chat with and talk over business issues, whether they be, issues of the economy or sales, but often they're personnel issues which make business quite complex at times. So it's really good to see someone who knows what they're doing filling that role. How rewarding do you find it?
Oh, absolutely. Because, the people I work with, I'm not trying to make them better, builders, plumbers, software developers, or, retailers. They're good at what they do. What they're not good at is what I call the business of business, and understanding where the money flows in their business and what levers they can pull in order to win themselves more work and be more profitable. So it is very rewarding, because often these people haven't had much formal training in those spaces, and they're, eager to learn. And, once they do learn, they become real sort of evangelists of understanding their numbers in their business. And, they look forward to month end and year end and, tracking things, and it becomes an enjoyable part of the business instead of sort of a black hole that they try to avoid.
Yeah, unfortunately, there's no school of small businesses there where one can sort of learn it. And that can be complex because you're playing with your own dollars and career. And so the right sort of advice is very important. And one of the things I'm a big advocate for is that a modern small business has many complications to deal with. It has not only tax, but compliance, HR issues. There's just such a plethora of stuff that they have to know about, that having the right sort of advisors can really leverage them. Because I find, and this is particularly with trade-based businesses, that they can grow rather quickly. If you're a really good tradie, you can build your business to a couple of $1 million, but once they start hitting that sort of $5 million threshold, all of a sudden it becomes more about business and less about the trade. And their expertise, they could be the best electrician or the best plumber. When they did their apprenticeship, they did like 6 hours on business management, whereas now the majority of their days are off the tools and busy immersed in business management. And I suppose that's a gap that you can help fill.
Oh, definitely. And I just see it all the time. You got people who are really good at what they do, and they have to get off the tools, and they struggle. And just try and make it fun as much as possible for them because it's just so critical. And really the difference between a good builder, a successful builder and an average one is what happens in the office, not so much what happens on site.
Totally agree with that. It's the management trap that gets them at the end of the day. Perhaps we should, as way of a bit of a case study about working together as a team, particularly you're with the accounting, business coaching type area, and myself as far as the working capital and funding goes, we've managed to achieve some great outcomes for clients. And the first one that comes to mind is the SaaS business. That's software as a service. Perhaps if you can just give a summation of what the challenges were there.
Yeah, the challenges, and the opportunities for this software development business was that, they do have a good revenue stream, some great clients that pay them handsomely, really, for their software solution, which is quite bespoke and industry specific. So there's some quite good guardrails in the business, and they've got long-standing sticky clients. The problem for them was tech is an ever-changing landscape, and, I'll be the first one to mention the two letters that are the tip of everyone's tongue, which is AI, but it's really affected their business big time, but really in a positive way, because they had issues in that they had a code base that needed an overhaul and was causing a lot of maintenance tickets and problems for their users, and they needed a way to transition away and improve their cost base. So they needed to have some investment in tech resources in order to do that. But after that investment, they then had to look to downsize that in order to become a profitable business again, and not one that relied on the next sale. Like there's big implementation fees to be made, and they were sort of relying on that to pay the bills rather than their monthly SLA fees. So we had to re-engineer the business to reduce that reliance on implementation fees and make sure they were profitable on a month-to-month, ARR basis, average recurring revenue. And that did require some plugging of the gaps with some finance in the short term in order to, invest what was needed to be invested to increase the profitability and boost the usability of their platform using AI. And that's basically where I think we had a very nice lunch in an Italian restaurant, and you met the founder, and which I think is also an important part of it, being able to click with the client. And that's something that I appreciate when we deal with clients, that it's not just a transaction, you're sort of understanding their business and getting to know them as people, which helped a lot.
Yeah, and particularly in that case, it was a technology change, and it was about AI and how that's changing how a coding business or a IT development type business works. And, one of the challenges is that unfortunately, traditional financial institutions don't really understand that rearrange things in a business and to reduce your headcount. When the business has been established a long time, there are some pretty heavy costs associated with that. And if you're going to reduce your team from 10 to 5 because AI will fill the gap, the problem is how can I afford to get rid of the 5 people that have mainly been here 8-10 years that have some pretty big obligations that you need to pay out. And I think that's where we had to use multiple sources of funding to achieve that. But the outcomes have been put in place now, and the business is looking at a strong financial future.
That's right. If you look at where we were probably when we first started talking, and there was a significant gap between that monthly recurring revenue and their cost base, which we identified and had to restructure the resourcing to where they are now. They've pulled significant costs out of the business to the point that our goal was always 1 July to be cash flow neutral and profitable, and we've been able to hit that goal while meeting our obligations, which was challenging. But we did need to, get some short-term finance in order to make that happen. And then the other, challenge was, obviously going down the investment capital route would be the preferred option. But while you're still, struggling in the restructuring phase of your business, investors are reluctant to invest. So we needed to use some financing strategies in order to execute the restructure. But now we're in a much better position to attract investment because the investors are seeing that their money's being used for further development and not to plug holes and losses and fund the restructure.
It's important that the business is moving forward that way and making it more attractive to investors, because investor capital can be somewhat cheaper than short-term money, but you have to go down the short-term money path, the unsecured loans, to initially put things into a buoyant state where the business becomes attractive.
That's right. And obviously a business that doesn't have a lot of assets or, CapEx, it's not doing asset finance. So it's all really cash flow, makes things more challenging, which is where these solutions worked out well.
Yes, they did. And I suppose the other case study that we can share is a bit of a classic in the construction industry. And it's a problem that so many small businesses are facing today. I was reading just before we came on the latest Creditor Watch report, and it's talking about a three-way squeeze, and that is lower consumer demand, higher borrowing costs or interest costs, which is causing the lower consumer demand, but more importantly, how people are getting paid more slowly. And I use the expression 14 days has become 30, 30 has become 60, and 60 is now the new 90. And so many businesses that rely on their cash flow to fund, which just about all businesses in Australia do. There is always a shortage of working capital, particularly in small and medium business. And in this particular construction company, they had to wait. They had the classic problem of the cash gap, and that is that you pay your staff and buy your raw materials, and your staff are maybe 7 days and your raw materials are 14 to 30, but your customer is paying you 30, 60 or 90 days down the track by the time the work's completed. And that leaves that rather big gap in between. And we were able to introduce a debtor finance program that basically brought forward the cash that the business was owed. And what sort of effect do you think that's had on the business now?
Oh, it's been a real game changer, because it is, as you say, Martin, that classic case where this particular construction client was basically a large subcontractor to the actual project manager, a little bit down the pecking order, I suppose. So the project manager, designer, head contractor would be invoicing their client, waiting to get paid. We would invoice our client, and you're forever sort of at the bottom begging for money, which just took up an inordinate amount of management time. So rather than spending time building the business, most of my conversations with this client were about who's going to pay when, making payroll, managing your BAS, your PAYG, your super, and all this for a fundamentally profitable company. If I look at the bottom line, they'll probably make 500K this year profit for a, owner-operator business, which is quite good when all that money goes to him. But again, when he looked into his bank account, the money just wasn't there because it was in the bank account of his client.
There are, thousands of business owners having sleepless nights right now because they just don't have the liquidity they need. And some of their major clients are paying them no longer at 30, they're paying at 60. And that all of a sudden leaves a full month of cash gap that they have to deal with. And it's something that, it's not just an economic cost, it's an emotional cost of dealing with the stress. All of a sudden, when you've got liquidity, you sleep better at night because you're not worried about making payroll tomorrow or fixing up that supply bill.
Oh, absolutely. And just literally the time spent, managing, daily, weekly and monthly cash flow was just inordinate. So now to know that, okay, yes, we understand there's a PAYG or a BAS bill coming up, but we know that we're doing the work, we're generating the invoices, and the invoice facility can be drawn down to fund that, rather than, what a lot of businesses unfortunately also have to do is relying on a payment plan with the ATO. So to be able to move away from that was a huge benefit, and, the risk of DPNs and, other things affecting your personal credit rating, even when you're profitable.
Yeah, the ATO is often reporting defaults in relation to tax payments on people like Creditor Watch, and that it's almost a double-edged sword, because when you look and say, oh, look, I can implement these things to fund the business, and that way we can increase our liquidity, we can service our tax arrears and bring things back in line. But whether it be a bank, a lending institution, or one of the fintechs, when they see that the tax department has defaulted them for $100,000 in outstanding tax, all of a sudden that changes the credit score and changes the attitude of risk. It was always there, and the lender knew about it, but now everybody knows about it. So that means the suppliers know about it, and they want to shorten terms that they provide, which further increases your cash gap. And it's an awkward circle. So I talk to people a lot about ATO issues, and basically getting into a plan or getting it paid off ASAP is going to make running your business so much easier. And it basically gives you a competitive advantage. If you've managed your tax, you're unlike the rest who haven't. Because when the supplier looks and does a credit check on you, it's going to see, what I call it clean skin. Everything looks all right there. There's no defaults or whatever. And there's your competitor, and they've had 2 tax defaults and a supplier payment default. And which one's going to get the better terms? Better terms means you don't have as much liquidity problem in your business. So running a clean and healthy business is about keeping those things under control.
Absolutely. And I think, it's something that's probably not front of mind, this manner of financing. So people didn't quite understand it. So the solution that we ended up with has been quite good, because they've been very good at sort of hand-holding and explaining how the portal works and the platform and drawing down money, good transparency on the fees. And, they've been, the communication's been excellent. Whereas, in a lot of the other financing options, it's not so good. And being able to use, what is one of the only assets in the business, which is accounts receivable, to finance your business is a great way to look at it. When, again, this business is not capital intensive, and other than, using the family home, which also has, complications, it's just a really easy, clean way of financing. And it's, it's probably something that you would know has been around for, I don't know, decades, centuries, but the modern platforms have just made it a lot easier to manage. Because, in my previous experience, it was the paperwork of invoicing, factoring that was difficult. But now the fintech side of it has really made it quite simple and transparent.
Yeah, and look, unfortunately, it sort of has some negative connotations in the community, that word factoring. But that's why I use the term invoice financing, because, yes, we are technically borrowing, but we're borrowing against the money we're owed. Yeah, it's not like creating new debt on the balance sheet. We're just bringing forward the money that our customers owe us. And particularly when customers are getting slower at paying, it's a very effective tool, and it's something that I'm seeing a lot more happening with. And there are some new products that are coming on the market where they use AI to look just at your zero or MYOB balance, and will basically give you a credit limit based on that without doing all the invoice swapping around. They're a little bit fussy about their credit criteria, but there are some incredibly versatile new tools that are available with the introduction of AI to the market, which you and I are talking about AI early next month, and I'm about to send out the invitations.
Terrific. Well, I was wondering if you're going to make that segue, Martin. Thank you very much. Yes, we are pulling together a little dog and pony show for the two of us. So yes. That will be interesting. And I'm talking to some of the people that I'm inviting, this whole notion of how AI is being used to evaluate their credit score. And, it's not just the old, I'll send me a link to your bank statements and your zero is going to be quite interesting for people. Because it's no longer, unfortunately, relationships. It is, computer says yes, computer says no. So you've got to play the game. Exactly.
And I suppose to sort of wind up, I'm just wondering, how do you see the economy going for the next 6 to 12 months? And, I always say when you're forecasting, make them regularly and often, because they tend to be more accurate. But I'm seeing a lot of uncertainty in the community, particularly about the new capital gains tax. We're approaching the end of the financial year, and it looks like we might have a war that's no longer on, with fuel costs and so forth are going to change. But how do you see things going?
Yeah, I think, a lot of clients and business owners will be happy to see the end of FY26, really, between the war, the impact on fuel prices, interest rates going up, and then the third whammy of the tax changes in the budget have really been quite difficult. But I suppose what I'm finding is, people with good, solidly run businesses that have a nice niche and supportive clients can actually see difficult times as an opportunity. I always, explain to people that it can be a chance that when the pie is shrinking, if you're a good business owner, you can take a larger portion of that pie. And then when the pie goes back to its previous size or expands, you retain your increased slice. So difficult times can also be an opportunity, but it comes back to what we talked about at the start. You really need to have your back of house sorted, understand your numbers and your margins. Otherwise, you can be sort of sleepwalking to a difficult financial situation.
Yeah, and look, I agree with you. Tight times are opportunity, provided you can use the right sort of funding tools like debtor finance, or, as long as your liquidity's there, because your competitor who doesn't know their numbers and doesn't have their liquidity under control, they could fall over. You have a great opportunity. You can buy all their stock at fire sale value. You can take
up some of their staff.
Yeah, pinch their staff, get their customer list. So many of the great fortunes have been made in tight times. So I think it's a business owner needs to have, one, the right advisors and funding, but also the attitude that's important, because if you look at it not as a threat but as an opportunity, it changes what you're thinking. And I'm seeing, particularly on LinkedIn, so much negative information about the tax changes, which to me are not that onerous. But anyone would think that, it's just loud lobby groups making a lot of noise that's further robbing business of its confidence at the moment, I think.
Oh, exactly. It can, become a bit of a crutch, as in I'm not successful because of what the government's done or the economy's done or the Reserve Bank's done. And it becomes a self-fulfilling prophecy. So, don't get me wrong, you need to get good advice and, manage those situations as best you can. But it can't be something where, you put your head under the doona and hope it all goes away. You've really got to confront it and see it as an opportunity. It's always darkest before the dawn is another, phrase that I throw out to clients. And I think FY27, once we've readjusted to where we need to be, can be brighter for most businesses. But things like avoiding, being credit referred or, reported is just something where you absolutely need to be aware of it, because it can be a really significant negative for your business. So making sure you've got the money available when you need it. It's the old, again, a comment of, when you need the money, it's the hardest time to get it. So when you don't need the money, do the right things to have it available.
Money always arrives late, is rule one. And the second is we only lend money to people who don't really need it. So the idea is to look at your liquidity and borrowing before tight times, or until, when you're in better shape, so that you can maneuver your way through.
Yeah, because I'm sure if you're a lender, you're going to be looking for lower risk deals. So why not position yourself as that lower risk deal and get access to money, and you'll have one up on your competitors.
Yeah, exactly. Well, look, thank you very much for your time, Nigel. Is there anything you'd like to say before we go?
No, I mean, I think just reinforcing that, that personal touch is also something that can be lost. So, I always encourage, when we have a new client, that you meet them in person and understand who they are. What are the C's of credit, character, and collateral? So I think character is an important one. Capacity. There you go.
Capacity and credit. There's four
C's.
Yes, they are. But and particularly as we've already mentioned AI, but we're in this world where, both of us could be digital avatars at the moment. The situation is people like to deal with people they meet, face to face, shake their hand. It makes a whole difference in the trust. I grew up in hospitality. My parents had hotels, and my dad would come back and say, oh, the bank manager said yes, or the bank manager said no, or he said maybe, or we should be doing this. There was a personal touch with the banks. They would meet and know their clients, shake the hands, come out and see the business. Now, small business doesn't seem to have a stable banking situation from anyone. You you're lucky to see your banker, and if you do see him, or the best you'll get is a phone call when the thing is, oh, negative, we want to reduce your facilities. That's about the only time you hear from them.
And hence your role is so important, I think, because you probably do have better relationships with those funders, and if you've got a relationship with the client, so the intermediary role is becoming all the more important. Whether it's mortgage brokers or commercial finance business, it's really important that you can help people out, and I appreciate your help too.
I totally agree. Well, thank you very much for your time, and we'll get you back on the channel down the track when we hopefully have a few more case studies we can roll through.
Absolutely. Thanks, Martin.